The Dow and the S&P 500 hitting 3-month highs Tuesday, and the S&P up now for the fifth time in the last six sessions, rising 0.4% today. So, how much more upside is there? Well, let's ask Nick Colas of DataTrek Research, joining me from his home in Manhattan. Well, Nick, neither social unrest nor China trade tensions are setting back the markets. So, given this big snapback that we've seen since late March, how much more room is there on the upside?
It does feel like there's some more room. We're thinking at least 5 to 10% more. And that
Mhm.
confidence is based on two things. The first is that corporate earnings really didn't fall out of bed as much as they might have over the course of the past 3 months. This year's earnings for the S&P are going to be roughly $128 a share. And if we see the usual recession recovery next year, it's going to be more like 150. And putting a 20 multiple on that gets you to today's prices, which seem reasonable enough for a recession. If we can get better earnings growth next year, the market has more upside, and that's what's going to have to get filtered through the system over the next couple of weeks.
So you're saying 5 to 10% over in terms of a time frame. How many months are we looking forward for that?
Through the rest of the year. We've seen these gains slow down. We do have up days and down days. We still have a lot of volatility. Wouldn't be surprised to see that come back again. But to your first point about things like social unrest, we have to think about the historical record and realize that 1968, when the U.S. was really in a period of tumult, in many ways analogous to today for a variety of reasons, the S&P was still up 11% on the year and ended the year on the highs in December. So as tough as all these images are, the capital markets focus on earnings and just earnings, and those have come through okay.
All right, so conscious doesn't matter, I guess, when for the markets. What about ESG funds? I was looking at your daily note, and you noted that those socially responsible funds, the ETFs, they've had huge inflows this year. What's behind that? And I know it gets debated year after year, but do they make good investments?
Yes, you're right. They have had a fantastic year. 85% of all the money put into ESG funds, ETFs, has come in 2020 alone over the last 3 years. So it really is a theme that's hit its stride. And given everything going on, investors clearly want to feel that they're doing something more with their money than just buying the S&P 500. And that's great. It pulls money into the capital markets, and it does force companies to think about how they score on these ESG metrics. As far as how good they do, it really does come down to understanding what you own. Most of these funds still own a market weight in energy, for example. So, as much as there's an E in ESG, if you're worried about things like carbon emissions, you really got to look through the details or ask your advisor to look through the details and make sure that you're not investing surreptitiously in ExxonMobil or Chevron or Conoco or any other big oil companies.
Energy actually has sort of gotten a bit of late today. In fact, energy is up. What are your thoughts on the outlook for the energy sector after that huge drubbing that it took earlier this year with the discord between Russia and Saudi Arabia? Then again, it's a cyclical stock, very cyclical.
Yes, you're so right. I mean, our look on energy is basically constructive. If you believe in a recovery, and we do, and you're looking for beaten up groups, and energy certainly is down still 30% on the year, then big cap energy, small cap energy is definitely one place to overweight. It's only 3% of the S&P now, so you can only overweight it so much, but it is one area that you're right has just gotten shellacked and should come back stronger than the market over the course of the next 6 months.
It has been the economic recovery thing that has been driving the markets up of late. All right, thanks a lot, Nick, for sharing your thoughts with us today.
Thank you.
Our thanks to Nick Colas of DataTrek Research. I'm Fred Katayama in New York. This is Reuters.